Welcome back to our intermediate financial accounting class. In our last few sections, we've been talking about earnings per share. We've talked about what it is, why it's important, all the different rules that go into calculating basic and diluted earnings per share. And then we started talking about the journal entries that go along with dilutive securities. In our last segment, we specifically went through how to record the conversion of a bond. Now we get to take a look at how we convert preferred stock from preferred stock to a certain number of shares of common stock. And to help us out, we're going right back to Simon Corporation. So in addition to the bond that we looked at last time, Simon has 100,000 shares of $10 par value, 7% cumulative preferred stock. They were originally issued for $12 a piece, and each one includes a conversion option for 4 shares of that $5 par value common stock that we were looking at last time. What we want to know is what happens if 20,000 are converted, and we're going to do the journal entry for that. Just like when we did the conversion of a bond payable, the first thing we need to know is what's on my books for these preferred stock shares. I've got to know what's in the preferred stock accounts so I know what to pull out and put into the common stock account. We have 20,000 shares of preferred stock that are being converted. If you want to look at the 100,000 and then convert 20%, that works too. But I'm just going to focus on the number of shares that we've actually got. 20,000 shares, $10 par value. So in my preferred stock account will be $200,000. The other account that is associated with preferred stock is additional paid in capital preferred stock. For those 20,000 shares, I would have the $12 they paid me minus the $10 par value. The difference goes into additional paid in capital for preferred stock, just like it does for common stock. So that would give me another $40,000. Now that I know that, I'm ready to do my journal entry. Let's go ahead and deal with what's in the preferred stock account first. Preferred stock is an equity, so it's got a credit balance. If I'm going to get rid of it, I need to debit preferred stock by the $200,000. I need to get rid of additional paid in capital preferred stock of $40,000. Now that I've taken it out of preferred stock, I need to put it into common stock. So just like we did for the bond, I need to figure out how many shares of common stock we're issuing and what the par value will be for those shares. So we've got 20,000 shares of preferred stock, and each one gets 4 shares of common stock. So that's 80,000 shares times that $5 par value. What needs to go into my common stock account then is $400,000. And I'm going to bring that right over here. $400,000. Now, if my debits are more than my credit, then the next thing I do is put that extra into additional paid in capital, and I'm done. In this case, though, I don't have $400,000 on my debit side, but I have to put at least the par value into common stock. That's the rule. So when it doesn't balance out, then I use retained earnings to make up the difference. So as a plug figure, I would need $160,000 of retained earnings to cover this shortfall in my conversion. And I'd have some explaining to do to my investors why retained earnings dropped because of the conversion. It means that I didn't set this up very well and I got burned when they converted. This is the conversion of 20,000 shares of preferred stock for 80,000 shares of common stock. And that's all there is to converting preferred stock. It really is a straightforward process. Remember, for all of my conversions, it's simply a matter of taking out what's on my books for the bond payable or the preferred stock or whatever else I'm converting, and then putting that into my common stock and my additional paid in capital account. And if I offer some extra incentives, I throw in a conversion expense. If I end up not having enough to at least put par value in common stock, I use retained earnings for the difference. That's all there is to it. Now, that wraps up our discussion of the examples we've already seen in the past. What we need to talk about next is something we haven't looked at yet, and that's stock options. So we'll be talking about that when we come back. More fun journal entries to come. We'll see you then.